Here's another clip from Cathy Wood, CEO and founder of ARK Invest, an investment management firm. She's talking about the inverted yield curve. Usually when you see that under the black line in the middle there, when it dips under, that usually means a recession is coming. Recession technically hasn't hit. She's calling it a rolling recession, that we've kind of been in one already and we're going to continue. That should come down back under that black line. But she gives an interesting point. Listen to her take on how this could be a repeat of history when it comes to innovation.
And then finally, just the yield curve. I always like to go back to this and marvel that even though the monetary and fiscal authorities around the world threw everything they had at COVID, the yield curve could not get back to the steep levels it has seen during past fiscal and monetary stimulus moves. I just think there is more of an underlying deflation message here, although at the same time you would expect to see high yield bonds being more jittery if this is indeed the case. So we're still wondering about this one. We know there's a message here. The downtrend is still in place. And maybe the message is, and just to end up on innovation, maybe we're going into a time just like the 50 years that ended in the late 20s when telephone, electricity, internal combustion engine were coming of age. And during that time, we were on the gold standard, so there was really no inflation problem. There were boom busts, but inflation was essentially zero when averaged out. But there was a deflationary tendency associated with these new technologies. So the yield curve was inverted. Even during the best of times, it was inverted most of the time at an average of 100 basis points. So that would be taking us down to where we were just a couple of years ago, 100 basis points on average, with inversions significant as 500 basis points at times. We're looking for clues that we might be in that same kind of period, and what you would see is the short rate being influenced by very strong GDP growth associated with these new technologies, certainly on the unit growth side, and the long bond being influenced more by the deflationary undercurrents that were associated with these new technologies. And of course, we were on the gold standard, so it was not an inflationary world.